macros now. Rajeev Malik is veteran economist, founder and director at Macro Shanti. He's joining us right now from Singapore to take some questions on what else but the economy. Rajeev, it's always a pleasure. Thank you very much. So the wait continues.
My pleasure.
The wait for a stimulus, some help from the government. What do you make of what may come and the wait itself, and what it may tell us about what the government may be thinking, or its understanding of how serious a problem we're facing?
Well, I think a good place to start, Prashant, is to just think about when the budget was presented not so long ago. There really wasn't any concern, so to speak, that there was an imminent slowdown or a substantial slowdown that would actually warrant some kind of a stimulus package. The budget really didn't talk about it, hint about it, and lo and behold, just a few weeks after that, we are actually talking about a dire need of such a package. Quite frankly, take a step back. I mean, India is one market where views continue to suffer from what I'd call a bipolar disorder. People are or views are excessively optimistic, or they are excessively negative. And I think the pendulum has swung towards the latter side. Quite frankly, seeds of this slowdown have been there for quite some time, several months. It is just, I think, a lot of people in the government have tried to ignore it or gloss over it. In fact, even the MPC, if you look at its minutes, bi-monthly meeting details, has been unduly optimistic about growth. And I think even now, having incrementally cut its growth forecast, it is still optimistic. So it's a foregone conclusion that something is going to be done. How significant, especially on the fiscal front, is going to be set by the limit in terms of what is felt to be responsible enough, how much of slippage they can undertake on the fiscal front. On the monetary side, we've already seen some interest rates come through, reductions come through. Obviously, transmission is weak. I would have thought that should actually make the case for even more aggressive rate cuts. Obviously, the current dispensation thinks otherwise. And finally, the third lever that any economy, policymakers in any economy can try and use to mitigate the impact of a slowdown is on exchange rate management. And that, to a large extent, India doesn't excessively use too much of it, partly also because it can be somewhat counterproductive. So we've seen rupee depreciate, but I think a lot of it is in line with what's happening externally, and that is not necessarily going to change all that much. So the focus is really going to be on the fiscal front. Within the kinds of areas they can try and target, it will have to be consumption. Investment is not really going anywhere in any meaningful manner. There could be a bit of pop as far as infrastructure-related spending is concerned. Liquidity is not an issue, but transmitting that liquidity into credit growth obviously is. And that's not going to change overnight. So I think the main area to be targeted is going to be on the private consumption side, which is really the growth engine that has actually started weakening. It was really a one-pony trick for a long time as far as India's growth momentum was concerned.
Rajeev, good morning. Good listening in to you. And really, that is the question, right? When you anyway don't have too much ammo in terms of too much fiscal elbow room, and then you try and throw more money out there to spur consumption, I mean, how prudent would that be? And even if we talk about sort of tax cuts, be it on GST or direct taxes, how much fiscal slippage do you think can the government sort of digest?
Well, that's the gazillion-dollar question, and I think what is equally important is to think about ways in which that fiscal slippage can actually be reduced, be it stepping up privatization or trying to monetize any of the existing assets, for example, land banks, etc. Those are something that require creative thinking, have been tossed around for quite some time, but obviously not much action has been taken on them. But my sense remains, purely from a political economy perspective, when push comes to shove, fiscal slippage is not going to stand in the way of having to deal with a more meaningful slowdown. So we will see some slippage, whether it is 0.2, 0.3 percentage point of GDP remains to be seen. The question is going to be whether that additional slippage is complemented with both measures that try to monetize and therefore limit the slippage, and B, complementing it with some structural reforms, which certainly there's a lot that can be done.
Rajeev, what is your assessment of this sense of urgency? Should there be a sense of urgency in terms of dealing with the economy? Do you feel that the powers that be are cognizant of it? Because a lot of the sort of commentary in the media, etc., is maybe and people are now starting to despair that why is it taking so long? I mean, is it understanding of the issue, or do you think it's basically deliberations with regards to what needs to be done so that it's sustainable?
Well, it's a combination, but I think don't forget, markets' sense of urgency will always be far more pronounced than policymakers. Because markets, investors want instant gratification. That is really not the perspective policymakers try and address things with. Having said that, I think policymakers in India, both in Delhi and Mumbai, have woken up to the slowdown somewhat late. Now, part of it could be not necessarily wanting to blow the whistle on that. I understand that aspect. In fact, even the MPC, part of the reason why perhaps it has stayed away from cutting rates 50 basis points at the last meeting or even earlier while there was ample room, might be perhaps they didn't want to quote unquote scare investors that, wow, there's a fairly substantial slowdown in the making coming about. So I think the slowdown is clearly there. Is it the end of the world? Absolutely not. But clearly you have to try and cushion it, put some support so that it doesn't actually continue in that particular direction.
Rajeev, the other point, of course, there is a big argument for lower interest rates. And yes, the government and the RBI is now pushing for better transmission as well. But liquidity seems to be quite okay. Banks have been parking 1 lakh crores or 1.5 lakh crores back with the central bank, on a daily basis. And then you have situations of either corporate fraud or sort of bankruptcy, willful, unwillful, whatever default. We have an Avanta Group company where questions are being raised now. So my question to you is this: is it really just a liquidity issue, or is the issue far deeper? Because a lot of bankers that we're speaking to are now raising the specter of perhaps a second wave of NPAs in MSMEs or some of these defaulting companies. So then are we setting ourselves up for something far more severe?
Well, the issue was always far more than liquidity. The issue about easy liquidity was purely to at least have some kind of an ameliorating impact as far as the whole situation was concerned. Actually, if liquidity had continued to remain tighter, things would have been even worse. So easy liquidity is not the be-all and end-all. It is just a contributing factor to try and limit a lot of other stuff that's happening. And don't forget, there's so much of crap that's been hidden under in different places. More of it is going to come out in these stressful situations. Part of the issue, once again I go back, is there was global growth, India largely a domestic investment cycle that really wasn't growing all that much. Obviously the consumption side started to peter off. We've seen savings rate as far as households are concerned coming off. So a lot of these things come together. And while one can, debate till the cows come home, pun unintended, whether or not it is a cyclical or a structural slowdown, there are reasons for both. And to me, the simple question is ask yourself or ask any number of businesses or analysts, has their expectation of trend growth rate for India actually come down? And the answer would be an emphatic yes. And that tells you whatever the cyclical cross currents, headwinds, there is a structural dimension as well. And denying it is only going to make things more difficult in coming up with some kind of a remedial response.
Fair enough. Trend growth rate for India has come down and some response is required. Rajeev, so just to get a sense in terms of what investors, foreign investors who've been big sellers recently, are making of this economic debate that we are having here. How do they view it?
Well, I think it's quite interesting how quickly that sentiment in a way has changed, right? And I think budget in a way was a turning point in terms of some of the steps that were actually taken. And even though you can go about, the government can try and correct them, some of the damage has already been done. It's not necessarily lasting damage. I think the key issue is going to be how do you enhance that confidence once again. Belief in the India story that, look, this is a slowdown, but there are some constructive steps that are being put in place, both from a near-term cyclical management and in terms of enhancing the structural story. And I think that will require some effective selling, not just a spivvy marketing aspect, but convincing with some relatively reforms, tough reforms even, so that people actually buy the argument that yes, business is meant here, rather than just denying the problem or actually just saying, look, everything is hunky-dory, because that actually scares investors even more.
Good listening in to you, Rajeev. Thank you very much for the conversation today. And let's see what the next couple of days bring if we indeed get some policy action from New Delhi. Thanks for joining us today. With that, we are completely running out of time. The market is just struggling around the 11,000 mark. That's all that we've done in the last 1